Jim, I want to start with what a shakeout in the private markets look like. We've seen it already in the public markets. The VIX spiked, stocks tumbled, a couple of risk parity funds blew out. But what does the equivalent look like in private markets as those markets work through all the wreckage?
Well, I mean, it's interesting, Scarlet and Joe, and thank you for having me on. It's never a dull moment these days. What's going on? We can discern the private markets in a few different buckets. I mean, you've got private funds, you've got private equity, and then of course things like venture capital and elsewhere. And the thing that is most intriguing to me is sort of the trials and tribulations of private equity and how private equity is sort of trying to present themselves to Washington and elsewhere as in need of assistance. I took a look at the four largest publicly traded U.S. private equity companies, and at their year-end letters, they boasted, this would be Apollo, Blackstone, Carlyle, and KKR, they boasted of having over $300 billion in dry powder to put to use when there were values or distressed situations. So I'm a little bemused, puzzled, and somewhat outraged, I guess, that private equity would be pushing to the front of the line here to try to get taxpayer assistance. That's one observation, and I'm sure that as we say, when the fear turns to anger post all this, we're going to be looking at how fast some of these programs were put together. I noted today that, for example, the state of Nevada pointed out that professional gamblers would be eligible for expanded unemployment under the CARES Act. Now, so I guess we're at the point where the U.S. taxpayer is literally bailing out gamblers. And so those sort of things I think the public is going to come back to, and we're going to see some of the externalities of these programs, have political and other costs to them.
We'll get back to the gamblers in a minute because, I think they totally poker players deserve a bailout too. But on the private market for a moment further, I mean, we've seen a lot of big institutions and pension funds feel they have to up their allocation to private equity. There's also this idea that maybe private markets, mask volatility and appear to give appear smoothness. Do you think in the coming quarters that will be revisited, that after a spike like this, that pension funds and committees will perhaps reevaluate how safe or uncorrelated these returns are?
Yeah, so I'm not only an investor and run a hedge fund, I also allocate capital on a couple of investment boards, so I hear the pitches all the time. And what's so remarkable to me, and I think private equity is possibly at a crossroads similar to where hedge funds were post the global financial crisis, and that is people are going to start judging the high fees and the illiquidity and say, am I really getting the return commensurate for the risk? And prior to the virus, I think the answer was a qualified perhaps not, and that an awful lot of private equity hadn't returned a whole lot better than public market returns. And then when you adjust for the risk and the leverage and the illiquidity, they might be found wanting. I think that going forward, we're going to have to see. I mean, again, what everybody loves about private equity is the smooth returns, but life isn't that simple.
Right.
And I'm not just so sure that those smooth returns aren't more a function of short, sharp market declines, and we might have just seen another one, by the way, where the market snapped back immediately. So the real pain of having to take a multi-year markdown doesn't occur in anybody's portfolio.
So, Jim, I wanted to bring in a question that a Bloomberg Terminal user has just posted to you. Where in the market do you think you see investors most mispricing risk, both to the upside and to the downside?
So what we've been telling our clients and the way we've been trying to position this, and it's been tricky, is to look at situations where the companies had questionable business model in 2019 and arguably in 2021, with the idea that 2020 is a write-off, right? That everyone's going to just disregard whatever happened this year and say, well, no one could have foreseen this, and it was certainly the black swan of black swans, the 5 standard deviation event, whatever you want to call it. But there are lots of companies that are almost troubled today that are still trading at valuations that would have been seen excessive, looked at backwards in 2019 or even in 2021. And forget short selling, just investors should be looking at their portfolios and trying to weed out those kinds of situations, because you're getting a chance to sell those companies back at pretty premium valuations. And I think that you might not have thought that 3 or 4 weeks ago, but here you are with a lot of companies that were losing money in 2019 and are going to be losing money in 2021, back to, if not their February highs, certainly within a stone's throw of it.
Well, let's talk about some of these companies that you've been talking about for a long time. I know you're famously short Tesla. That stock had an incredible run-up. It's still up massively for the year, even with the diminishment of risk appetite. At what point with this company, in your view, does the story component get busted? Because that seems to be keeping it alive, that the secular story is just so great. When does that end if even a crash like this can't let the air out of a company like that?
I hadn't noticed. Look, you know my view on this one. I mean, it is a story stock that's being held up by people who want to believe that it's on the cutting edge of whether it's autonomy or an EV vehicles growth or whatever it might be. But again, I keep coming back to this tired old bromide that this is a car company. It looks exactly like a car company. It's been trading more recently in line with the car companies in terms of its moves up and down. It has to lay people off like a car company, not like a Silicon Valley software company. It has manufacturing plants like a car company. It's got a lot of debt like a car company. I mean, so investors can convince themselves all they want that this is a software company or this is some leading-edge technology company. Sadly, the numbers belie that. The numbers show this is a car company. They will lose money again this year, so that'll be 16 or 17 years in a row. This is not a startup anymore. Right. And so at some point, investors will simply have to say, okay, yeah, other guys have EVs too, and they're all in the space, and EV growth was negative last year, 2019 versus 2018 in the U.S. Units were actually down, which is sort of interesting. But it's a car company. And so far that has not been the correct call, I will admit.
Okay, I hear what you're saying, Jim, but at the same time, Tesla does seem to get special treatment. China, for instance, giving it special dispensation to keep its Shanghai factory open and operating through coronavirus. Does it hurt your thesis if China continues to backstop Tesla?
Oh, that's even better. In case you've forgotten, I'm not really positive on anybody having anything to do with China. So I think China exposure ultimately turns out to be a negative for this company. I think one of the things that has been lost in the coronavirus news flow has been a really severe deterioration in U.S.-Chinese relations in the last sort of 4 or 5 weeks. China threw Western journalists out, as you guys know, and we've had the advent of another wave of frauds in U.S.-listed Chinese companies. I'm not so sure that Elon embracing Shanghai and the Chinese Communist Party is going to turn out to be a positive.
Yeah, let's talk about that, because I do think one of the big questions that people will have is, even after the world returns to something resembling normal, by which I mean it's safe for people to go back to offices and to travel and so forth. Right. Everyone is asking, well, what is going to change? There's going to inevitably be something different. What do you see as the most concrete way to say business and U.S.-China relations will change, whether it's on the sort of pure business front or the capital markets front?
Well, the biggest change will be how will businesses look at the supply chain issue. That's the $600 the 1,000-pound gorilla, I think, in that will companies that are dependent upon China for essential parts for their businesses move production out of China, or at least second source out of China? What does the political situation look like, whether it's President Trump or President Biden, and how does China fit in that? I think things are hardening rather than softening right now. I mean, some of these headlines out of China would have just a year ago, when we were in the midst of the trade spat, would have been just sort of unbelievable. But because of the virus, we've sort of put them on the back pages, and I think that's going to come back to the fore as businesses and people in the financial markets try to figure out, okay, how much exposure should I have to the Chinese economy? Is the Chinese economy going to go it alone in that respect if their export machine gets turned down a few more notches? And then what about this debt buildup? It still happens every year. The Chinese economic model hasn't changed. And I know people are sort of sick of hearing about it, but be that as it may, it keeps growing. Debt keeps growing twice the size of the economy in terms of growth every year. And I think that's something that we shouldn't forget.
So, Jim, when you look at what's going on in China, and we've had examples in recent weeks of Luckin Coffee, TAL Education, and some accounting issues there, Chinese state-backed media is now jumping on that and calling for Chinese companies to perhaps seek alternative listings, not necessarily in the United States anymore. Do you really think that this will come to pass, or is this China trying to call everyone's bluff here?
Yeah, I would go with the latter, Scarlet. I think that listing questionable companies on the Western financial markets is a feature, not a bug, for the Chinese financial system. They want that capital. They want that access to capital. They want those dollars. It's problematic from the get-go because of the whole, and I don't want to get too much into a wonky policy discussion here, but the way that Chinese companies are structured, that when they trade it in New York or elsewhere outside of China, is through the variable interest entity structure, whereby you don't really have a claim on the assets in China. You have a piece of paper sitting in a safe in the British Virgin Islands or the Cayman Islands, which gives you the right to the operating profits or the economic profits of the entity as they see fit. And so this is the problem when something goes really sour, like a Luckin or what else. Western investors don't really have recourse to the assets or via the court system in China, and that's a huge, huge problem. And China, I think, is very happy to have that structure and to set up access for Western capital to go into China through this VIE structure. And it's really a problem. And then on top of that, you have the issues that people like Senator Rubio and others have raised on the accounting and China not adhering to our accounting standards. So I think you're going to hear, once the virus subsides, I think you're going to hear about these issues a lot more going into 2021.
Jim, I want to go back domestically and talk about individual companies and sectors that may be affected or that people still haven't appreciated perhaps the ramifications of what we're going through. Lots of concerns about live events and the future of live events, anything. Live Nation having been a stock that's just gotten absolutely clobbered. It didn't even really bounce that much week along with anything else, the big concert promoting company. What do you think of the market's assessment of these types of businesses here?
Yeah, I mean, I think that the market. I mean, we are short live entertainment, Joe, and have been now for a while, and it fits into my bucket of a company that didn't make any money in 2017, 2018, or 2019. Is not forecasted to make any money in 2021 when the concerts come back, and is trading at 15 or 16 times so-called EBITDA here, based on last year's number, and this one fits into the bucket of I don't get it. Now we can argue when live entertainment may or may not come back, and I'm sure on some guys it'll come back, but will there be extra costs for health? For guest screening, for sporting events and for concerts? Will there be restrictions on the number of people in venues? I mean, I don't know. I have no idea. But what I do know is that the company didn't make any money when things were great. And so it fits into that model. If the business model didn't make a lot of economic sense prior to COVID-19, and now we have a new world of pandemics, I don't know that it should still be trading at premium valuations even today. And that's why I think there's an asymmetric risk-reward in things like live entertainment and a number of restaurant stocks. And I'm not smart enough to know whether the business is permanently changed, but I do know that a lot of these stocks have gone back to where they were back at year-end. And that, to me, kind of is puzzling.
So you mentioned restaurant stocks. I know you don't like the business model there, particularly for the likes of Dunkin' or restaurant brands, because they're asset light and, of course, they're heavily leveraged as well. What's going to be the deciding factor between which companies survive and which don't in this kind of environment where people aren't spending, they're not going out, and we don't know how long it's going to last for?
Yeah, so you've hit upon the problem. The so-called asset-light model, where investors bid up the prices of companies that were franchisors, and the debt was hidden, that the debt was at the operator level, at the franchisee level. And, we've seen a series of troubled franchisees, again, pre-virus. All you have to take a look at it. Look at Carol's Restaurants, symbol TASTE, T-A-S-T. They're the largest Burger King franchisee in North America of restaurant brands. They trade publicly. So you can actually see just how much their business deteriorated before COVID-19 and just how tough the quick service restaurant business has become as these asset-light companies have grown units so aggressively in the United States in the last 5 years. And so when you look at the underlying restaurants, you see just how troubled they are. And then you look at the franchisors, and many of them are still trading at premium valuations even today. And you sort of say, okay, well, there's a disconnect that doesn't make a lot of sense. Because if these companies were troubled prior to the virus, again, getting back to my theme, and even if we go back to business as normal, the poor franchisees are going to be every bit as troubled with just a lot more debt on top of them. And so I'm puzzled. I don't have to be an epidemiologist to sort of figure out that maybe these businesses shouldn't trade at big premium valuations to the market.
Right.
Jim, real quickly, because we just have like a minute to go. You've been notably skeptical about companies like Uber and GRUBHUB and some of these new economy businesses. The stocks are really slammed a lot. It's not like these are widely loved stocks. Why do you think investors still don't appreciate the downside risk here?
Well, first of all, none of them make any money. So I think that the business model didn't make sense beforehand. The food delivery guys are actually, they've held up, the GrubHubs of the world, because people believe that everybody's ordering in. But in fact, we're going to know sooner or later. But it looks like actually volumes are down for a lot of these delivery companies, food delivery companies. So again, if you don't make money in the first half of 2020 delivering food, you're never going to make money. And I've long publicly been saying that the business doesn't scale, that delivery drivers can only really deliver two meals an hour, and it's a body shop. But the bigger problem that the gig economy companies have is the nature of their employees, the fact that they're independent contractors. And I think post-virus, that is something that is going to change. I think we're going to treat these employees a lot better, and we should treat them a lot better. And the business model is much, much tougher in an environment where those people are actual employees and earn at least minimum wage.